In a significant move, reshaping the landscape of digital assets in the United States, President Donald Trump has enacted the first nationwide cryptocurrency regulation. This landmark legislation, officially known as the Guiding and Establishing National Innovation for U.S. Stablecoins Act of 2025, or the Genius Act, primarily focuses on establishing a federal regulatory framework for stablecoins. The Genius Act aims to provide clarity and consumer protection within the rapidly growing stablecoin market. Key provisions of the law include requiring stablecoin issuers to hold 100% reserve backing with liquid assets such as US dollars or short-term Treasury bills. Issuers will also be mandated to make monthly public disclosures of their reserve composition, enhancing transparency. Furthermore, the Act specifies that stablecoin holders will have priority over other creditors in the event of an issuer's insolvency. This legislation is seen by proponents as a crucial step towards integrating digital assets into the mainstream financial system and cementing the US as a leader in the global digital currency space. It seeks to reduce regulatory uncertainty that has long plagued the crypto industry, fostering responsible innovation and attracting investment. The White House has emphasized that the Genius Act will also bolster the US dollar's global reserve currency status by driving demand for US treasuries. Beyond stablecoins, the House has also passed two other crypto-related bills that await Senate consideration. The Clarity Act, which aims to clarify the regulatory authority of the SC and CFTC over digital assets, and the Anti-CBDC Surveillance State Act, which would prohibit the Federal Reserve from issuing a central bank digital currency, CBDC. While the Genius Act marks a major milestone, the broader regulatory picture for cryptocurrencies in the US continues to evolve. Washington, D.C. In a historic move for the burgeoning digital asset sector, President Donald Trump today signed into law the Guiding and Establishing National Innovation for U.S. Stablecoins Act of 2025, widely known as the Genius Act. This legislation marks the United States' first comprehensive nationwide cryptocurrency regulation, primarily targeting the burgeoning stablecoin market. The Genius Act aims to usher in an era of clarity and consumer protection for stablecoins, which are digital currencies pegged to traditional assets like the US dollar. A cornerstone of the new law is the requirement for stablecoin issuers to maintain 100% reserve backing with highly liquid assets such as US dollars or short-term Treasury bills. Furthermore, issuers will be mandated to publish monthly disclosures of their reserve composition, significantly increasing transparency for users. The Act also prioritizes stablecoin holders in the event of an issuer's insolvency. This landmark regulation is poised to legitimize the digital asset space and foster responsible innovation within the US financial system. Proponents argue that by reducing regulatory uncertainty, the Genius Act will attract greater investment and accelerate the adoption of digital assets. The White House emphasized that the law will also bolster the US dollar's global reserve currency status by increasing demand for US treasuries. While the Genius Act focuses on stablecoins, its enactment comes amid a broader crypto week in Congress. Two other significant crypto-related bills, the Clarity Act, aimed at defining regulatory oversight between the CC and CFTC, and the Anti-CBDC Surveillance State Act, which seeks to prohibit a central bank digital currency, have passed the House and await Senate consideration. The passage of the Genius Act is seen as a pivotal step towards integrating digital assets into mainstream finance, though the regulatory landscape for the broader cryptocurrency market continues to evolve. Increased legitimacy and institutional adoption. By establishing clear federal regulations, the Genius Act is anticipated to boost the legitimacy of stablecoins in the eyes of traditional financial institutions and the wider public. This clarity could lead to increased adoption by banks, payment companies, and other large corporations, potentially integrating stablecoins more deeply into everyday transactions and cross-border payments. Shift in market dynamics and competition. The new regulations, particularly the 100% reserve backing requirement, will likely favor larger, more established stablecoin issuers that can easily meet these stringent financial demands. Smaller firms might struggle with compliance costs, potentially leading to consolidation in the market. While this could enhance stability, some critics argue it might stifle innovation by making it harder for new, decentralized stablecoin projects to emerge. However, increased competition among compliant issuers like Tether and Circle is still expected, bolstering the US dollar's influence. A key consequence, as highlighted by the White House, is the potential to strengthen the US dollar's global reserve currency status. By requiring stablecoins to be backed by US dollars and short-term treasuries, the act could drive greater demand for these US assets, embedding the dollar's influence deeper into the global digital economy. Enhanced consumer protection and transparency. The mandate for monthly public disclosures of reserve composition and priority for stablecoin holders in bankruptcy are designed to significantly enhance consumer protection. This aims to prevent scenarios like past stablecoin collapses, building greater trust and confidence among users. Challenges and potential loopholes. Despite its intentions, the Genius Act faces criticism. Some experts point to potential loopholes regarding foreign-issued stablecoins or those operating through decentralized platforms, raising concerns about continued avenues for money laundering and sanctions evasion. There are also concerns that the Act's provisions, while aiming for stability, might inadvertently invite future government bailouts if a major stablecoin issuer faces insolvency, by prioritizing stablecoin holders over other creditors in bankruptcy proceedings. Additionally, critics note that current protections for investors in crypto under this bill are weaker compared to those in traditional stock markets. Impact on broader crypto market. While directly regulating stablecoins, the Act could have ripple effects on the broader cryptocurrency market. It provides a blueprint for future regulations, potentially signaling a move towards a more regulated crypto environment in the US. The accompanying bills, if passed, would further clarify regulatory authority over other digital assets, pushing the US towards becoming a more defined crypto capital. Dominance of compliant stablecoins. We'll likely see a consolidation of the stablecoin market, with larger, well-capitalized issuers that can easily meet the stringent 100% reserve backing and disclosure requirements, gaining a significant advantage. Smaller, less resourced projects may struggle with compliance costs, potentially leading to their decline or acquisition. Expect USD-backed stablecoins to solidify their market share as the preferred choice for legitimate financial transactions. Increased institutional participation. With regulatory clarity, traditional financial institutions, TradFi, like major banks and payment networks, are predicted to significantly increase their involvement in stablecoins. This includes potentially launching their own stablecoins, integrating existing ones into their services, and exploring new use cases for faster, cheaper payments and remittances. This legitimization will attract more institutional investment into the broader crypto ecosystem. Enhanced transparency and consumer trust. The mandated monthly public disclosures of reserve compositions will foster unprecedented transparency in the stablecoin market. This increased oversight and the priority given to stablecoin holders in bankruptcy scenarios are expected to build greater consumer confidence, potentially drawing in a new wave of users who were previously wary of crypto's volatility and lack of regulation. Challenges for decentralized stablecoins and foreign issuers. The Act's focus on centralized, fully reserved stablecoins might pose challenges for algorithmic or under-collateralized stablecoins, as well as those operating primarily on decentralized platforms, which may struggle to fit within the new regulatory framework. Furthermore, foreign stablecoin issuers wishing to serve US customers will likely face increased scrutiny and compliance burdens, necessitating adherence to US AML KYC standards. Broader regulatory ripple effects. The Genius Act serves as a precedent for future cryptocurrency regulation in the US. If the Clarity Act and Anti-CBDC Surveillance State Act also pass the Senate, the US will have a much more defined regulatory structure for all digital assets. This could solidify the US as a crypto capital, but also potentially limit certain types of crypto innovation deemed too risky or outside the new regulatory bounds. The demand for US Treasuries to back stablecoin reserves is also predicted to see an incremental boost.